Welcome to the Broken Pie Chart Podcast, episode 287. I'm your host, Derek Moore, back once again as my semi-permanent co-host, Jay Pestrichelli. Jay, you're not the only Jay in the news today.
I guess not. There's some guys, I guess he's more popular. Some people are probably going to pay more attention to what that guy said. But he's a Jerome and I'm a John, ultimately. Did you know? Right. You know I'm a John, but I go by Jay.
I do, but everyone calls him Jay as well. So he's Jerome and they call him Jay, and you're John and we call you Jay. Or you call yourself Jay. Or somebody decided to.
Who knows what other people call me? It's not always nice.
And you weren't in the news today, but you should be. All right. So today, Powell said the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. He did it. He capitulated. They're going to cut.
Yeah, he didn't take a hard stance. He didn't just lean into the two cuts piece, but you're right. He basically said, okay, time to, can I say pivot? He didn't say pivot. That's an older term we used about a little pivot here. Mm-hmm. Still data dependent though, right? Not single data point dependent, but still data dependent, they've proclaimed. So I think everyone's like, which is strange, like you look at the market today, we were, just a few, again, close to the all-time high. We've recovered, I guess this is the highest close we've had since July. When was that high? July 16th. So we've made all the decline back, and then we're, kind of getting back to the all-time high. So, I look at this and I don't know what was in the market today that wasn't already there, but the market just wanted to hear it, wanted it confirmed that rate cuts are coming. That's my reaction, or that's my commentary on why the market reacted the way it did. Probability of 2 rate cuts at one point touched 40%, I think, today. So that's up a little bit from 25. We'll see how that feels tomorrow. Derek, do you remember when the Fed meeting is? I think it's the middle of September, correct?
It is September 18th.
18th?
Yeah.
So we got a ways to go, right? For people's opinion change. You're going to have data. You're going to have a jobs number. You're going to have a CPI number. You're going to have a PCE number. There's a couple things that could still come out and change people's opinion or, reinforce it. But looks like people got what they wanted.
I think he went for like 18 minutes. It was scheduled for 30. I didn't, we had some stuff, some trades and different stuff. So I didn't see if he took questions. But what I can tell you in the implied Fed funds futures, and right now it's 36% probability of 2 cuts, which means 100% probability of 1 cut. At the November 7th meeting, 2.7 hikes are priced into the futures. And by December 18th, at least 4. Now, it's really I think those are aspirational. Like to me, I don't see them doing 50 basis points. And if you are hoping for 50 basis points, it means things have gotten progressively worse.
Yeah, I don't think you really want that, right?
No.
I think you want the optics of, 1 cut. Hey, we're changing kind of our bias. By the way, beginning of the year, September was the time that I thought 1 cut, but I still feel like the dynamic has shifted as to, they should do more. You forget, right? Part of what happened in the beginning of August was bad news. Oh no, we may have a recession, and everybody got what they wanted from the rate cut probability perspective, but not what they wanted from an equity perspective, right? So that little wiggle we had, that 10%, 9+ % decline, fueled by bad data. Again, I don't think we want the 2. The 2 to me seems like it's talking about worse. It's a worse signal, I believe, to send.
I agree. And you look at just we'll talk about the employment data and that revision in a second, but it feels like, and everyone's like, oh, if inflation goes back down to 2%, shouldn't the Fed funds be 2%? No. You historically, you have a gap. I mean, I think as we get older, Jay, you forget that we've been around a while now. And there's a lot of people who only have been in the markets or in our industry post GFC. there's a lot of people. I mean, that's their sort of reality on things, and the reality is more like the '90s
for the great financial crisis.
Yeah. I mean, it's really more like '90s and 2000s, where if inflation was X, you'd expect Y to be above X. It is what it is. So the idea that we have to go down to 2%, to me, I mean, if we're at 5.33 effective Fed funds rate right now, if at some point we go back down to 4.5, maybe long term 4%, and we actually go to 2, okay, that feels right. But you don't want rates to have to go to 0. You don't want rates to have to be cut. It means something is wrong in the markets. So, yeah, I think we're in agreement there.
Yeah, something wrong happened if that occurred, and then you got this whole kabuki dance to go through again.
I thought it was interesting with the markets today. I said, okay, if I want to put a bearish hat on, I can have a bullish and a bearish hat at the same time. They just look funny, because they're one on top of each other. But I would say that the bear would point out that, he pretty much said we're cutting, but there's nothing in his speech today that said, 50 basis points, or we want to aggressively do it. There was nothing for people like me about the pace of the balance sheet runoff or anything like that. So it was almost like, okay, yeah, it went up right away, and then it started to pull back, and I thought, that's coming in, and then it finished strong again. Maybe this is one of those where nobody got everything they wanted, but they got something.
I mean, I think a little conjecture there, but
conjectures are not my middle name, but why not? It's our podcast. We can say whatever we want.
There you go. Say what you want. You could still say, all right, I won't even go there. But I would say this is, I don't know. I think the Bears are going to have their day in the sun shortly. For a little bit. A little bit. All right.
This is when we hedge. We buy, we hedge. We don't try and trade off markets. It can come out
of nowhere. Yeah. Like the drop was pretty quick that we saw before. This will be an interesting test, right? Can we get through that high next week? Or are we, getting a little sideways consolidating and just buying ourselves a little more time? We'll see. Hard to listen, I am, of course, generally happy when the market goes up. It's good for clients, good for business. Like, it's good stuff. Don't get me wrong. But I don't know. There's a little, and I'm not the guy that likes to sell fear, right? I don't do that at all.
We would have more listeners. We'd have more than one listener if we sold fear.
We have more than one listener now.
We do, of course.
But the point, we're coming up on historically and seasonally the most choppy part of the year going into an election, and we've got all this, kind of Fed policy, interest rates. So I wouldn't get too comfortable when I look at the VIX here with the 15 handle. The last time we were up here, it was less. So the market is positioning itself, just knowing it could be a little dicey. I would love to be wrong and see 6,000 by the end of September on the S&P. That'd be great, but I'm not sure that's in the cards just yet. Could be before the end of the year, but just doesn't feel like just yet. We look at some volatility triggers here as well. And so while I know this wasn't on the docket to talk about, but there's a little bit of strangeness going on with the speed of the market intraday and the change in the VIX. So, one of our little triggers that we watch, one that really we like to pay attention, said, hey, be careful. Not a bad time to hedge.
Yeah. Well, always be hedged, but that's another story. The other nugget that came out of the speech today, this is going to be a T-shirt, a meme, or it should be. Powell said, quote, "The Goodship Transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down." I don't know. He wanted to explain once again that whole bit. Like, it was sort of a history lesson today on the on the Fed speech. But all right, whatever. The Goodship Transitory.
Can we not? We don't have to bring that one up anymore, do we?
I mean, they can't let it go that they were wrong. By the way, you and I both agree that nothing that they did caused inflation, and nothing that they did brought inflation down. This is all fiscal policy. Then you flood the economy with so many dollars, and at the very time that there were supply problems, you throw a bunch of gasoline on the fire. People order more stuff off Amazon. It's got to get on container ships from Asia to the U.S. I mean, really, I'm sorry that he has to answer the questions on inflation, but it's really the politicians that should be up there answering the questions.
Yeah, there's I think little so I agree with what you're saying generally. There's some little nuances where, because of the speed of the rate changes that they did in 2022, they caused the little banking disruption that we had in March. Right, when people said,
they slowed housing advance. I mean, they slowed the prices in housing, but
so I think where they can impact, they did, but they certainly didn't slow down corporate spending. Generally, corporate earnings didn't slow down. Just now, maybe they're starting to see a little impact in the employment data, but you and I both think that's just a function of the math and the denominator numerator thing. We talked about that last week. So not really a problem. And so, I'm with you. It was fairly ineffective.
Jay, he also talked about, and one of the reasons why he gave is the start. He sort of did this whole thing about why inflation started. We're not going to go through this whole thing, but I just thought it was interesting because he said, after the Russia-Ukraine startup, commodity prices spiked. I took a look and, just looking at a chart here, Jay, you have in front of you, the blue line is the CPI year over year percent. So the percent rise in CPI year over year. And white line, Jay, is the crude oil, the active month commodity future, West Texas Intermediate. And he talked about that. But you know what? The advance in CPI started in earnest in March of 2021. We didn't see, it was sort of slowly rose in 21. I'm talking about oil prices.
Yep.
It didn't go up above 100 until March of 22, but inflation was already high at that point. I'm calling what's another word that we don't curse on the podcast. I'm calling
shenanigans.
Yeah, sure. We'll go with shenanigans. No, come on. The oil prices is not the reason. It's really all goods. So
yep.
All right, let's move on. We talked about the Fed implied interest rates already. The thing that this talk of interest rate declines is doing also, it's lowering the dollar index. So why is the dollar index important? It's important because a weaker dollar helps our, generally sell stuff overseas in other countries and makes it less expensive on sort of their currency versus our currency basis. The other thing is most multinational companies are getting global revenue, but they report in US dollars. The reason why a weak dollar helps is because if they're selling a widget in country, XYZ, and there's a very strong dollar, well, you might sell it for the same price, but when you convert it back to US dollars, it's less revenue, it's less earnings. And we used to see companies mention this when the dollar was really rising towards the end of 22. But for the dollar, our earnings would have been 7% higher or something like this. Jay, the US dollar index, which is highly Eurocentric, meaning it's weighted against a lot of the European currencies more often than not, it's coming major support area. It's breaking down, and it's no surprise the market likes this.
Yep, good for stocks, as you just said, right? But so is this a position that let's take a look? Let's go out a little longer. So you're right. So we've been at this level a few times recently. Maybe the end of the 2022, middle of 2023, kind of tested it at the beginning of this year, and now we're back down. So when you think about this, Derek, it's kind of found some support here recently. Do you go all the way to where we were in 2021? Probably not. That was still, we were still in extreme cases. And so, if this levels out, Derek, and even bounces, what would you expect the impact to be the opposite on the market? A little pressure on the market if this number bottoms out?
So let's say the dollar rallies, bounces here and rallies. That wouldn't necessarily be good for the market. In fact, I didn't draw the market in here, but some of the peaks in the dollar correspond with intermediate lows on the market. I think the case, though, is because interest rates or currencies really are relative vehicles, and interest rates are really driving that. If we start cutting, I mean, you could make the argument that the dollar has more room to the downside than the upside, which would be beneficial to markets.
Another reason why cutting helps equities.
There you go. So, yeah, I don't think it has anything to do with inflation, but that's another.
So what's that do to, say, commodities like gold and oil? We just talked about oil a second ago. Mm-hmm. Let's throw gold into the conversation here, right? If the dollar drops, the value of gold related goes up, right? It takes more dollars to buy an ounce of gold, right?
Right.
So
same thing with oil. Sure. That's a great point.
And so, if you look, you don't have it in here, but like a chart of gold would tell you what? New highs, right now. Now, so there's other things in there, but as the dollar is down, gold is up.
That's
so
true.
Is that a way to? So let's say you're trading this. You're trying to figure out ways. I don't know how to trade the dollar index. Could you use gold as a proxy?
Well, sure. I mean, there's ETFs that do gold up, gold down. You could do the commodity, and don't do that, folks. Don't try that at home. But
what about buying some gold from Costco again? You remember that?
I haven't done that yet. I just want to do it.
I got a text from my wife a couple of days ago. Like, look, we can buy gold from Costco.
I could buy GLD though, and just hold it in my account.
Yeah, but I could get a bar of gold from Costco.
Don't you take a haircut when you sell it back to somebody?
But I could buy gold from Costco.
That's a good point. I might do that. I definitely want to do that. I want to get one of those gold bars.
I'm going to tell you. By the way, they're not always available, right? And I would love to do a study of when these are available to look at. Is there a demand-driven push on gold from Costco going out there? I'm looking. They've got this Statue of Liberty, 1 ounce, or they got an American Buffalo ounce. Fun stuff. You could buy gold from Costco, Derek.
I may do that.
Put it in the safe. Save it for the rainy day to hand to your son.
I'll tell you, at some point we may get him on the podcast, by the way. But I had lunch one day with George Milling Stanley from State Street, and he was involved in the creation of GLD, the ETF. So, and we talked about the Costco thing, but I don't remember the whole. I don't want to quote him out of context on it, but maybe we'll have him on at some point. We'll talk. Yeah,
maybe, and maybe I'll buy some gold from Costco this weekend if it's even available anymore. Maybe
he would take my side. Him and I agree that me and him would be on the same side of the Bitcoin versus gold argument. I'm just preparing you.
Prepare away.
All right.
I'll bring Michael Saylor.
I am going. All right, let's do it. So we're going to buy gold I'm going to do it. I just want one of those. I think it'd be pretty cool to have it.
Yeah. Get the whole collection.
All right.
You remember when the quarters came out with individual states, and it took like how many years before they minted every, all 50 states, and you got the quarters, and you had the big cardboard cutout, and you could put the little quarter in each one of the states. That's what you're going to do for gold. Every time Costco puts out, the new McDonald's character of gold, then you're going to get one.
I like it. All right, I'm in.
The grimmest gold bar. Wow, now I'm really getting off topic. Yeah. Sorry.
Do you remember when, this is pretty funny. So, we have paper dollars, and the whole idea was paper dollars are actually expensive because they degrade and you got to reissue them. So they wanted you to go to these $1 coins. And those of you who are out there and do a lot of frequent flyer miles, hotel points, and play the mileage game. So the Treasury would let people buy up to, I think, $5,000 of these $1 coins. And they would let them buy them on a credit card with no shipping charges. So people would buy like $5,000 a month of these $1 coins, and they just take them to the bank and pay off their credit card. But they get the 5,000 points a month. Yeah, there you go. Okay. People are pretty, ingenuitive. I guess is that the right term?
Resourceful.
Yeah, there you go. Okay. All right, we got to talk BLS revisions. This caused a stir. This was Tuesday or Wednesday. It came out. This is the largest revision down since 2009. I believe it was over 800,000 jobs over the last year were reduced. And what that means is, according to this revision, there were 800,000 less jobs created. So what is this? All right, first, this was on the establishment survey. So in the establishment survey is where they do a survey. They call up businesses. I don't know how many it is. I think it's several 100,000. And they just ask them, employment questions. And that's what the monthly numbers are in the establishment survey. There's a household survey, and that's the one where they call individuals. So basically, come January, you'll have the final revisions. That was the first one. I believe there'll be a second one and then a final. And usually the final one, on average, has about $100,000 more, 100,000 jobs
People.
more.
Yeah, jobs.
Than that. So this was a big deal, and especially in a political year. But Goldman Sachs has been telling us this is going to happen for a while. And the reason why Goldman Sachs talked about this is, so this is just the survey data. And then what they do is they go back and I think they look at like state employment records. So they call it quarterly census of employment and wages. But then, instead of surveys, they start to look at the actual data. But Goldman Sachs, this is back in April, they wrote this. They said U.S. unemployment would be higher if illegal immigration was properly counted. So, and I'll sort of explain this. Basically, their take too on the last one was that the surveys are more likely to capture illegal workers than the actual data that you get from the states. I'm trying to simplify this, and it's a long sort of explanation.
You're doing a heck of a job of it, can I tell you?
Okay. Are you being serious, or you're?
No, I was joking.
Okay.
So what you're saying is, as I'm thinking through this, right? This is
the first time you're hearing this, yeah.
Well, yeah, a lot of people. This is like this number came out, and people were like, "Wait a minute, why does this matter to me? Is it an annual thing? Is it a monthly thing? Like a little." I think the market didn't know how to digest it right away because it's in the past, like you said, Derek, it's been like, it hasn't been a big deal. This was a pretty big deal to kind of change that information. I think the market at first, when the impact here, right, is it's bad. We've been overstating a little bit, and then wait a minute. Maybe it's we're going to get the final numbers anyway later, but let's see how this all plays out. And this is a once a year thing, right?
Yeah, and I'll just read a 2-line quote from Goldman Sachs. Goldman Sachs analysts caution that the upcoming benchmark revision, so this was the day before, to U.S. non-farm payrolls is likely to overstate the weakness in labor market, meaning it's not a big deal. The revision could be misleading, is kind of what Goldman Sachs said. So, yeah, I mean, I think it's a big miss, but Goldman Sachs has been on top of this. I think the immigration story is maybe skewing some of the traditional data, and maybe there's not as much weakness from the headline number as people thought.
Okay. All right. Well, I think people will pay probably a little more attention to the monthly number as from this, but like you said, probably not that big of a deal.
Yeah. I mean, there's also things too where Goldman talked about as people come here, they say a third have likely filed for asylum, which means they can apply for work authorization after 150 days. And by the way, this gets to the point of you made earlier, the reason for the rise in unemployment is not a reduction, people losing their jobs. It's more people coming into the workforce. It's a big difference. So
big difference.
And, maybe everything goes to heck in the handbasket anyway. So, who knows?
Okay.
All right. Anything else on that?
Nope. I'm good.
I love this stuff. Yeah, I could talk about this report for an hour, but you can't, and our audience would hang up. So we'll move on, Jeff.
I almost hung up.
All right. Well, let's keep things, I don't want to say political, but some politicians. Yeah, let's do it. Why not?
I mean, we just watched the Democratic National Convention come to a halt. So it came to an end, whatever you want to say. For us, it was last night. It was a couple of days ago from when you're hearing this. Yes, let's talk a little political stuff. And what's the chatter? What's the chatter?
Yeah. By the way, I don't watch award shows. I certainly don't watch conventions. I'll just be honest with you.
I wanted to see what the nominee was going to say. I wanted to see her speech.
Didn't watch any of it. Any of them. All right.
Not everybody in my house made it through the whole thing. Go ahead.
All right. And you don't want to listen to my my employment numbers thing. Okay. But you watched a political thing.
I did.
One of the policy initiatives that one candidate has talked about is the idea of sort of price caps on things like groceries and other essentials. And the argument is that companies are making record all-time profits and the government should step in. So first, I would tell you that price caps have never worked. It leads to a lack of supply. I mean, it's been done. It's been tested in history. It doesn't work. You also get unintended consequences. When the government put a cap on wages after one of the world wars, guess what happened? Well, company, to get around it, started offering company-sponsored health insurance. This is how the whole thing sort of started getting going. But Jay, I just thought it was be interesting. I said, so I pulled up, let me see, Albertsons. And Albertsons is a grocery store. I don't know if they're nationwide, but they have them out here in Arizona. And I said, what is their profit margin? Well, their profit margin is expected to be over the next 2 years about 1.73%, meaning if they sell something for $100, their cost is basically, call it $92.30. So not a lot of big profit margin. In fact, their profit margins are lower than they were in 22. And then I just pulled up Walmart and I said, well, Walmart's a pretty good proxy. Are they gouging? Are they making record profits? All right, no. They're they're between 2 and 2.5%. And in fact, they had better margins back in 06, 08, 10, and 12. So I would say, I don't know. I mean, the talking about putting wage caps on these types of places, not wage caps, price controls. I don't know. I mean, net profit margin doesn't lie. They're not making record all-time profits.
Well, I think it's just, by the way, I agree with you. You and I are in alignment on this. I don't think companies are gouging people right now. I just think it's the, so I'm going to be careful here. It feels like if you were the political party that probably caused inflation, then to go out and be like, it's the company's fault. It's right. Like, I mean, it's a little like, pointing, it's just both sides do this, right? But it's just kind of, pointing the problem somewhere else and how you're going to go attack it. You probably caused it in the first place. So I just, this thing, so the data that you're talking about is great because it gives facts behind the, the nonsense of this, I don't know why I'm using that word conjecture, but this kind of, all the chatter and the opinion this week. So I'm with you. This is, I don't think there's much to go after here, right? It's political clickbait.
By the way, Apple, I took a look at their net profit margins too, and they are, grocery stores have like very, very low profit margin. Even at the Costco, it's only like 2.5% probably.
They should sell more gold. I bet they do better.
Yeah, maybe that's the way to go. Apple, by the way, has had a greater than 20% net profit margin. This is only going back to 2011. But I took a look at this one. They had a high at 27% net profit margin in 2012, and they've had 25, 25, 26 respectively the last 3 years. So, I mean, pretty consistent, above 20s. This is why it's difficult, Jay, to do a discounted cash flow analysis where you anticipate the next 3 years and then you put them in a perpetual, for the next 30 years, they're only going to earn this much. I mean, Apple stayed above 20% profit margins for quite some time. Good for them. Yeah,
good for them.
Yep.
You might have heard of that company. It's a pretty strong company.
Yeah, although I have a lot of their products. I would be in favor of wage as long as the products don't change and the supply is still there. Let's cap the prices on cell phones. I'm all for that. I'm kidding. I'm not all for that.
They're only going up, buddy. All of a sudden, you're going to get those expensive chips in there, and your phone's going to be able to do everything. Plan your vacation, handle your schedule all day, maybe even answer some emails you get. By the way, where can people reach you if they wanted to email you, Derek?
Yeah, the best way is derek.moore@zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. All right. I want to talk about just sort of let's go back to volatility for a second. I'm done with the political stuff.
Good.
I'm done with that. So I think just going, we talked about the rise and fall of volatility. And then typically when volatility is high, it stays high for a while. We saw it come down. But I will say, yesterday, so we're recording this on a Friday, yesterday, the market pulled back quite a bit. I mean, opened higher, pulled back.
Yep.
But the day before, I noticed the VIX was rising into the towards the end of the day. So we had an up day on Wednesday with a rising VIX. And I just, when I see that, sometimes I say, well, why is that? And sometimes it's mechanical. But I don't know if you have any thoughts on that. Okay,
so I do. It's a little contradictory sometimes when people see that happen, and it happens, right? You know what, Derek? I think there's a little more going on under the surface in the kind of the movement in the market that the VIX is starting to get a little leery of, right? And so what I say, like intraday, then I know not everybody sits there and watches the tick by tick of the market intraday, but when you look at some of the jagged movements that we've seen, it almost feels like, it certainly doesn't feel like the beginning of August, but it's almost what am I going to say? Like you have this symptom of that could be the case, meaning you could have a very fast moving market. And I think you'll see the short-term volatility trades reflect that. And what do I mean by this? So the VIX is a very, the options on the VIX, we know we can't trade the VIX directly. You got to trade the futures or the options on the VIX. They are a very leveraged way to take advantage of these snap movements, right? Sometimes the options market is a way to do it, it's on the S&P itself. But when I look at the movement in the VIX day to day against the market and see that kind of a breakdown of the inverse correlation that you normally would expect, to me, there's something kind of a little under the surface, and you got to watch for that. It's not always right. Sometimes the option traders and the VIX and the way that the calculation works out can be a little deceiving. Again, I mentioned it earlier. There's a few, and I'm the only reason I have this, a little bit of a bearish bias is we're just seeing some of these kind of undercurrents in the option market, in the VIX market, even in the VVIX is something else that we watch. That is not giving an all clear sign. I think I said on a podcast, we probably at some point have to retest that bottom in August. Maybe this is what happens as we retest the high. Then we got to retest that short-term low, and we'll see what it looks like. I'm not saying it has to get all the way down to where it was on August 5th, but there was some real technical damage there, and the options market is still preparing for that kind of a move. So I think when you get those gyrations you're talking about, Derek, I think it's something just to be a little wary of and just to watch. Who knows? The market can go straight up from here and volatility go down to 10, but it just doesn't seem like historically the direction that where we're going.
I feel like in the last couple of years, there's been the turns sometimes happen quicker. And we've referred to other people have done papers on this, the idea of you have these air pockets that sometimes happen. But I don't know. And the other thing that you hear is because the options market now, I think by many accounts, notionally, there's more traded in the options market than there is in the equity market. So changes as the underlyings get to different spots and the market makers have to hedge or take off things, I think it happens a little quicker now. And so I don't know.
markets are moving faster. Yes, that's true. And, the idea of the air pockets, talking about air pockets, right? This last little run that we had up in the S&P the last couple of weeks definitely created some air pockets, which are great when you use them as kind of the buying and bullish signal, which felt pretty good, a week ago. Let's just see if those gaps get filled. That's one of those things we always talk about on the S&P. Gaps get filled. So I don't think it has to be too far down of a move, though, to kind of fill all the gaps that we had. But, we finally today filled the gap down. So this is Friday. We filled the gap down that we saw from July 16th down to July 17th, right? So there was a gap that day of, let's see, we closed on July 16th. I know I'm going back a month here, but it's relevance here. Closed that day at the high at 56.67. The next day opened at 56.10, right? So that difference of really, it's almost 1%. That 1% gap has to kind of get filled. And we pretty much closed that bar. We didn't get to the all-time high, but we kind of closed what that bar looked like. I don't know, Derek, maybe this is just one of those air gaps that had to get closed. And now we're going to start to see, again, some quick movement. I still think, down moves happen faster than ups, but the ups have been very quick as well along these lines, right? 3 or 4 days used to take a couple weeks to get back to where you were. This time didn't take that much. So we shall see.
We shall see. I still believe, my 600 is still out there. It's within range, right? But the time is getting shorter to get to 6,000.
And I'm with you on that. I do think that's a reality. I just don't know if that's happening September, which is historically the worst month of the year.
What will be interesting, too, is as we get to the end of the year, well, really it doesn't happen until December. What do the analysts have as their targets for 25? The easiest thing is just be like, oh, we have 8, our baseline is 8% or 9% or 10, simply the average.
Yep.
But
the average.
We'll see.
I know we're gonna come up against predictions again. It's a little early, but we'll see.
I'll have to pull ours and see how long
we're kind of almost 3/4 of the way through, right?
Yeah.
So might not be bad to take a look at some of those things. So let me ask you a question, right? If Jay's making all these statements here after today and yesterday and some triggers and stuff, are we changing our position on hedges? So I'm asking you, but I'm really asking myself. So have we made any changes on our hedges yet, Derek?
No. It's the nice thing about having a systematic process is you're always hedged. You always have them on. Now, we may optimize things. So there's times where it makes sense to roll them early if they're not, really materially providing protection. Sometimes we monetize the hedges if they are profitable and the markets go down. But, I think that's what you were going for.
Yeah, that's exactly right. Like, just because it's fun to guess what's going to happen in the next 2-3 days, but when you are disciplined and have a rigorous process on hedging and revising and updating the hedges and moving things around, you don't have to make a guess at, oh boy, I didn't hedge, I better go hedge now. There's rules we have around that too. So it's just one of those things. I just thought I'd bring it up, that just because we're talking about this, it doesn't mean we're repositioning. We're not changing the construction of our portfolios. If you're in the hedged portfolio, you're getting it all the time, right? Those strategies are always hedged. They're always managing risk. If you're in, really, we have one tactical model, Derek, really, right? The one that kind of will act on these triggers. And it's a very small percentage of our book, but it's one that, people have asked us to say, hey, can you run some, projected risk on, risk off models based on what you're seeing in the options market? And we do. But that's it. And we'll see. That model got us bullish at the bottom of the market a couple weeks ago, and now has us taking some risk off at this level. So I don't know if that's right or wrong, but that's what that model tells us to do. I don't want to quote performance here, but it's one of those things. If you want that information, reach out to Derek. But it's one of those things that if you're aggressive, the model has been constructive this year.
Yeah, no, I would agree. And it might be a piece of somebody's portfolio. There's different things that do different stuff to really simplify it. All right, Jay. Let's see. I didn't really watch anything new this week. I finished Dexter, by the way, but now I found there was another new season on, what is that? Showtime, Paramount, or something like that.
Yeah, so that's so you watched the original,
yeah.
Right? And were you slightly disappointed with that ending scene? With not the scene, but with the ending?
It's like somebody put an intern on the final to write the final scene.
Yes, it was a disappointing ending to Dexter, but I think leading up to that, it was good, right? I think you would agree with that. Even when he had even some kind of rivals in, anyway, I don't want to give too much of the show. It's been out for a long, long time, so I'm not ruining it for anybody, hopefully. But the other thing about it is this new season, I think you'll appreciate the twist, and his sister is in it.
Oh, okay. Okay.
Which, by the way, might be one of my favorite characters. She's right. She's a cop, but she's a little bit of a potty mouth, and but very realist. So I love that character. You get her in the new one.
All right. Yeah, I'll check it out. Well, it's kind of like when I watched Breaking Bad. I loved that. And by the way, Breaking Bad, I thought they landed the plane. The final episode was great, but you always kind of wonder, oh, what happened to so-and-so? What happened to so-and-so? And I love that they did just a 2-hour movie afterwards.
You like that one?
Oh, it was great. It was great.
All right.
So yeah, you should really watch Breaking Bad. Just do it. Just commit to it. Get it over with. It's good.
All right. I will. Look, I've tried a few times and I haven't. Last week I told you I was going to watch 2 movies. I liked them both. Mm-hmm. What was the one I told you? The Bad Boys I watched. I think I told you I was going to watch that. The new one. Entertaining. And then I was pleasantly surprised with the Ministry of Ungentlemanly Warfare. I think that was the name of it.
Okay.
It was a little based on actual kind of a real group where, do you know the background of Ian Fleming, right? The 007 writer,
yes.
Right? The guy who created that.
Yeah.
So it touches base on really the character or the real officer that we think that character is based on in Ian Fleming. So good. I thought it'd be just kind of a, like whatever, a entertaining little action comedy kind of movie. But I would say the fact that it's got some bearing of truth in it is interesting.
All right. No, that's, by the way, yeah, I don't necessarily like the same movies as you, but sounds like a strong buy on that one.
No, buy.
Yep, a buy.
I'm going to say buy, right?
Okay.
I would hedge it. I'm hedged on my buy on this one. I did not give the
there's stuff on Apple Plus TV as well. So
I'm 2 episodes into Bad Monkey.
Good.
So far, so good.
Okay. All right, Jay. That's it. The Goodship Transitory is sailing off. We'll be back next week with more things that probably won't.
Do you think there's containers on that Goodship Transitory?
There ought to be. Oh yeah, big container ship. Probably 20,000 40-foot box containers for sure.
All right. Have fun at Costco.
I'm going to get my gold. See you, Jay.
Bye.